Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you today to talk about capital budgeting techniques which are traditional. So, the topic would be traditional techniques of capital budgeting. So friends, we started with this series of financial management a couple of weeks ago, and at the very first day we discussed about what is financial management and objectives of financial management. The foremost objective of financial management is to increase the shareholders' wealth, which means we want to increase the wealth, the value of shares of shareholders and the market price of the shares. So, the value goes up if the price goes up, right. So, the shareholders wealth is the product of market price of shares with the number of shares we have. So, the question comes in, how do we do that? So, we do that by our decisions, with the help of our decision, because the company, when it takes any decision, a message goes into the market about the return capacity and the risk taking capacity, the opportunities it has. So, risk return opportunities and the capacity of the company, that is been absorbed by the market. Market sees either this is a company which will be growing in future or not, how much risk this company has, how many returns it is giving and it is likely to give in future. All these things are the deciding factors for the market value of shares of a company, which in turns increase or decrease or rather affects the shareholders' wealth, right. So, the maximization of shareholders' wealth is the ultimate objective of financial management, and we actually divide all the business decision into three parts for the purpose of shareholders' wealth increment. First is investment decision, then we have financing decision, and lastly the dividend decision. So, the topic which we are covering is the part of first decision, which is investment decision, right. So, where do we invest? When I say investment decision, where do we invest as a business? We take into consideration those investments which are into long term assets, right. So, capital budgeting decisions pertain to long term in assets. So, it could be modification of the current fixed asset, it could be addition, it could be deposition, it could be any such thing which relates to long term assets, which affects the earning capacity of the business, of course, profitability in the long run. So, the capital budgeting decisions becomes very important because they are irreversible. Most of the time they will involve a huge outlay, and the most important thing is that the outlay which we are spending today is going to give you return in future, and the future is uncertain, right. Since the future is uncertain, we are not sure how this particular investment decision will result into either profit or loss, right. So, it has to be taken care very well. We have to decide about the investments of long term assets very carefully, right. So, for that we select long term proposals by generating proposals, by evaluating them, by selecting them and then making a follow up. So, this is the process we make for capital budgeting decision. Now, to take a final call about the evaluation of decisions, we use couple of techniques. So, what are those techniques? The techniques which we use in capital budgeting proposal evaluation, they fall under two categories. One, which are non-discounted techniques, we call them as traditional techniques or non-discounted techniques. The other techniques which are known as modern techniques or discounted techniques. Today we are going to concentrate about only the traditional techniques. In future we will be talking about the discounting techniques or the modern techniques. So, the traditional techniques which we are going to discuss today is number one, accounting or average rate of return, and number 2, payback period method. So, we are going to cover these two in today's discussion. So, I am going to take the first one now, which is accounting over average rate of return, and later on we will talk about payback method. So, as the name suggests, accounting rate of return or average rate of return. So, why did I use two words accounting? Because the calculation of accounting rate of return and the average rate of return, you will see there is a slight difference in calculation method in different books. So, that is why I would be talking about both, and I will be discussing both the methods, so that there is no confusion in your mind in case you refer any particular book in future, right. So, the accounting rate of return does not focus on cash flow, that is the first important thing. It focuses on accounting income or net operating income. So, we do not consider cash flows, because in past we have discussed that for capital budgeting decisions, generally, of course, for the modern one, discounted one, we use only cash flows. But this is the only technique which is known as accounting rate of return or average rate of return, where we do not use cash flows, rather we take only accounting profits, and precisely we take net operating income for calculation of accounting rate of return return of any proposal. So, the formula which we use is like this, we call it as accounting rate or simple rate of return. The formula goes like that we divide annual incremental net operating income by initial investment. So, the annual incremental net operating income. So, please be careful about, I am talking about annual income which is incremental and which is operating from operations, from business operation, and we divide it by initial investment, right. So, and this initial investment should be reduced by any salvage from the sale of old equipment. So, friends, when I say annual incremental, what does it mean? Incremental means let us say I was earning 45,000 prior to the proposal I am discussing at this moment. My net operating income was 45,000, and now since I am reviewing a new project, new modification of or new plant, new machinery, my total net operating income is likely to be now 85,000. Earlier it was 45,000, and we are assuming, we are making an assessment, a forecast, that if I accept this proposal of installing a new machine, new plant, new building, new anything, or modification in the current machinery even for that matter, my new total operating income would be 85,000. So, from 45,000 to 85,000. So, what is the difference? 40,000. So, for this proposal which I am evaluating with the help of accounting rate of return, I am not going to consider the total amount of 85,000. So, what I am going to consider is the difference, the increment. The increment is from 45,000 to 85,000, means the difference which is 40,000, that would be taken as annual incremental net operating income, right, and we will divide it with the initial investment. Now, the initial investment is going to be reduced by the salvage of the sale of the old equipment. So, if I was replacing an old machine with a new one, I was replacing an old equipment with the new one, or anything like that. So, if I have something left, residual of the previous equipment or the old equipment, old machinery, that is what we call it as salvage. So, we are going to reduce the investment required for this particular proposal with the salvage value. So, let us say if the salvage value of the previous asset is 50,000, the old one, and my new investment is 10 lakh. So, it means my initial investment is 10 lakh minus salvage of 50,000, which means 9 lakh 50,000. So, my denominator would be 950, the initial investment, not the 10 lakhs which you see as a actual purchase price, right? That is the formula. So, now we are going to take one small caselet to understand this accounting rate of return. So, the caselet goes like this. The management of the ABC Limited wants to install an espresso bar in its restaurant. This bar is going to cost 1,40,000 and has a 10 years of life. So, company is ABC Limited and it is intending to install an espresso bar or coffee bar, right, machine, espresso coffee machine. How much it will cost? 140,000, and life of that particular machine is going to be 10 years. In addition, the information is it will generate incremental revenue of 1 lakh and the incremental expenses are 65,000 including depreciation. So, what would be the accounting rate of return of this project? So, friends, we have to see the net operating income which is incremental. So, since the incremental revenue is 1 lakh, it is not the income, right. So, be careful while reading any caselet. So, it is revenue which is 100,000 which is 1 lakh and the incremental expenses because of this machine, the expenses which will go up are 65,000. So, the difference of 1 lakh and 65,000 which means 35,000 is what? That is what is my incremental net operating income. And how much was the investment? 140,000. So, accordingly my accounting rate of return would be 100,000 minus 65,000 divided by 140,000 which is the investment. So, net incremental income 35,000. So, 1 lakh minus 65,000 divided by 140,000, the answer would be 25%. So, that is how we calculate accounting rate of return. It is very simple and we have not considered cash flows. Rather, we have considered only the operating income as per the books of accounts, as per the accounting books. So, which are actually based on accrual, right. We are not considering the cash, we are just considering accounting profits basis on the accrual concept. So, this was the accounting rate of return. So, how do we calculate the average rate of return? So, these are the two methods, accounting rate or average rate of return. So, both are correct and different books, and there are a couple of books which shows both of them even. So, the ARR, the average rate of return, could be calculated by another formula which is average annual profit after taxes divided by average investment over the life of the project multiplied by 100. So, average annual profits after taxes are taken average. So, if let us say if I am earning a total profit of 10,000, 20,000 like that, in 5 years if my profits are 100,000 or 1 lakh, but the amount is not consistent, right. So, what I will do, I will calculate the average profit dividing 1 lakh by the n, and n here we are assuming as 5. So, my average profit becomes 20,000 and divided by the average investment over the life of project. Now, here I would like to clarify couple of books, or most of the times when we do not have data about the salvage etc., what do? We take average investment as opening investment, closing investment divided by 2 or simply investment value divided by 2. So, it all depends what type of data or what or values are given in the case or in the question. So, I will just discuss that the average profit after taxes are determined by adding up the after tax profits expected over the life of the project and divided by the number of years. The results are total value or results are divided by the number of years, and average incremental investment is determined by dividing the net investment by 2. And there is another way to calculate average investment, So, I am discussing both because one you may find out in one book the average is just by dividing the 2. Another books may be showing the average investment as the net working capital plus salvage value plus 1/2 of the difference of initial cost of machine or investment minus salvage value. So, initial investment minus salvage value divided by 2. So, 1/2 of this, right. So, 1/2 of the difference of initial cost of machinery and salvage value, and we add up salvage value, we add up net working capital required. So, that is the average investment calculation. So, depending upon the what kind of data is available in a situation, in a question, we use the formula, right. So, but this was my responsibility to discuss elaborately all the possible formulas used in different books. So, now we will take up a small example or a caselet to understand average this particular average investment and average rate of return also. So, first of all, let us understand how would we calculate average investment by using the salvage, the second formula, right, not dividing by 2, the other formula. So, here if I take an example, if the initial investment, which is purchase price, if it is 14,000, salvage value is 2,000, working capital is requirement is 24,000, and the serviceable life of the project or the machinery is 5, and the method which is used in depreciation is straight line. So, what would be the average investment? So, average investment, if you remember, the formula is we add up what? We add up the working capital requirement, right. We add up this net working capital plus salvage value, and we divide it by the 2 of difference of initial investment and initial investment and the difference of salvage. So, difference of initial investment 14,000 minus 2 is 6,000 plus the working capital 24,000. So, 6 plus 24 30,000, and plus we will add up the salvage value, and the salvage is 2,000. So, the answer should be 32,000 as per this formula, right. So, this is how we calculate the average investment. Now, we will be discussing, after discussing the average rate of return or accounting rate of return by both the formulas, the next thing I want to discuss is the merits and the demerits of accounting rate of returns, or in other way, I would like to now spend some time in critically evaluating this accounting rate of return technique of capital budgeting, which is a traditional technique, right. So, the merits of this accounting rate of return are: number 1, it is easy in calculation; number 2, simple to understand; number 3, the total benefits are considered; and number 4, this is a very old method and acceptable method. So, the first one, easy calculation. Why? Because this is the only technique where we use accounting profits. We do not use cash flows. Accounting profits are the values which are available as it is in the books of accounts of any business, right, which means we need not to mend any data available in the books. To calculate cash flows, we need to mend the available data in the accounting books of account, whereas in this particular method of accounting rate of return, we simply need to take the value of net operating profit, the previous one and the new one which is expected, and this can be simply calculated by any accountant easily. So, the calculation is very simple and easy. And the second is that we are very comfortable in understanding as a businessman, accounting profit is something which really goes like this. The businessman would understand exactly what does it mean, that how much average operating profit would be out of this particular project, because this is something they are growing with, they are thinking of, they are working about. So, this is very simple to understand because we do not change any data here. We simply see the accounting profits as they would be in future, because in future we are not going to compare anything else, but the accounting profit which we are forecasting today, right. So, it becomes easy to understand, to comprehend for anyone. So, the third point is that we consider total benefits which are going to happen for a project, because there are a couple of methods, especially the payback method, which we will be discussing after some time today. So, in payback method, we do not consider the total amount of cash flows which are expected to happen over the life of the project. But in accounting profits, in this method, the average profit or the operating income is taken on an average. So, whatever the profits I am going to expect, because there are projects, if you can think about it, there are projects where the first year, second year, third year, maybe even 5, 6, 7, 8 year, we do not earn anything at all. And then suddenly the gestation period is over and we really start, there is a quick jump, quick start in earning the profits. So, if I take those initial years, there is no profit, or there could be a project where initial first year profits are there, but very minimal, then gradually they are going up, right. So, if we consider the complete lifespan of the project and the profits earned there too, then certainly I am going to decide basis on the overall return this project is going to give me, or this machinery or the plant is going to give me. I cannot ignore the profits after certain period of time, or I cannot ignore what I am earning now. So, this is a very good benefit that in this method we calculate the average accounting profits or operating profits basis on the profits expected over the life of the project, not for any particular number of years. And lastly, it is a very old method accepted by all, and this is something which is there in everybody's mind. This is something does not require much of the work, much of the calculation, and a very acceptable method worldwide. To apply any other modern technique of capital budgeting. So, most of the businesses in actual, I am talking the reality, they will use payback method, they will use accounting rate of return, and along with that they may use IRR, they may use a net present value. So, this becomes the initial ground or decision to use or to evaluate other methods. So, this is something which is used by everyone along with, of course, certain more methods which are discounting techniques. What are the demerits of this method? So, this method has couple of limitations, of course. First of all, it considers accounting profits and not cash flows. Number 2, it ignores time value of money. Number 3, no consideration for incremental cash flows. And number 4, no differentiation between the size of the investment. So, let me discuss all these points one by one. So, as I said, the first thing is that though it is easy, it becomes the benefit as well that businesses are going to use accounting profit, not cash flow, but this is a limitation as well, because for capital budgeting decision, the cash outlay is happening today, or maybe in today as plus something in future as well, right. So, since we are paying in cash, since my outlay, what I am paying is in cash, so I should be comparing the cash inflows as well with these outflows, right. So, the cash outflows are going, the cash outlay or outflow are the same thing, right. If I am considering outlay as cash, I should be considering inflows also which are in cash, not in accounting profit, right. So, this becomes a limitation that when it comes to outlay or outflow, we are considering cash. When it comes to incoming income, we are considering accounting profits. That is the first limitation. The second limitation is it ignores time value of money. Time value of money is a fundamental concept in financial management, and it is not used in accounting rate of return. Why? We are not, when I say accounting rate of time value of money in accounting rate of return method is not used, means that we do not discount the future inflows, which means we are considering future inflows at par with the current inflows. So, we need to actually discount the future inflows, which we are ignoring completely, right? That is one another limitation of the time value of money. The third limitation is there is no consideration for incremental cash flows. Since we do not consider cash flows at all, there is no question of considering incremental, isn't it? So, that is another limitation of this accounting rate of return. The last and the foremost important limitation or demerit of accounting rate of return is that no differentiation between size of investment. Right? Look at this example to elaborate this point. So, there are three machines ABC, the average annual earning is 12,000, 4,000, 8,000, average investment is 60,000, 20,000, 40,000, right. So, what is accounting rate of return? The ARR in all the three methods is 20%. What do you learn by this? So, the point I am making is, if I have to take a call as a business basis on ARR, accounting rate of return or average rate of return, I will consider all the three proposals same, right, because they are giving me the same return in term same results of ARR 20%. But the fact of the matter is there is a huge difference between these three proposals. In one proposal I need 20,000, in the last proposal I need 60,000, right. So, it really makes a difference that if we have the different size of investment which are not taken care by this formula. So, these were the demerits, and the purpose of discussing merits and demerits was to critically review the accounting rate of return method. I hope you were able to gather a fair idea that what is accounting rate of return, how different formulas are used in different books and in actual, and what are the merits and demerits of this particular technique. With this, I would like to wind up, friends. Time to sign off. Thank you.